Hey guys, welcome to the first video in this section on portfolio theory. These videos are generally going to focus on core asset management and microeconomic topics essential to portfolio management. This video is going to have two parts. First, we're going to look at the return on a portfolio of $1 invested that's 100% in the stock market or 100% in the treasury bill market since 1970. And then second, we're going to look at the power of compounding fees and how they can be significantly distorted by asset management fees, usually charged by advisors or other investment funds. Now we have to set the working directory and grab the file download just as we did in the portfolio optimization video section. If you need some help with this, I would just go back and review video 1. But again, just use the setwd function, remember the 2 backslashes, and then use the read.csv function, entering the file name and then .csv. I went ahead and defined the matrix of sample data as we did in the previous videos. Essentially, I combined the date vector, the return on the market, adding back the risk-free rate to get the total return, and the column of the risk-free rate in the sample data. I then defined the sample data in between 1970 and 2018 and defined the returns between that. This is very similar to the process in our portfolio optimization section, so if you have questions on that, I would review it quickly. Now, to actually calculate the return, we'll start with the time series function that has 3 relevant arguments here. The first argument in the time series function is the date of the time series values. We're going to combine this with the cumulative product function, which returns a cumulative product vector. We're going to subset this with the second column, which is our total return on the market. We're going to divide by 100 for percentage terms. The second argument is the start of the actual time series, which is going to be identified as 1970. And the frequency of compounding is going to be determined by the number of trading days per year, which is DBY. Now, the process for the risk-free rate is going to be the same thing. We're just going to subset on the third column instead of the second. The next step in this video is to actually plot the time series. We're going to use the plot function, and then we're going to also use the cbind function that's going to combine the 2 time series. And we want to plot them on the same plot, so we're going to use the plot.type argument, and quotation single will plot them on the same plot. And for our labels, for the y-axis, we're going to label it as the return on $1 invested. And then for the x-axis, we're going to label it as the year. And we want to plot the 2 time series in different colors. So we're going to use the color argument, the COL, and combine that with the colors black and red. And you'll see the plot populated soon. And the last thing we need to do is add a title for the plot. And I think it's best to call this the return on the market versus the T-bill since 1970. And you can see that the return on the market has far exceeded the T-bill since 1970. However, when we calculate the sample statistics soon, you'll see that's because there's a lot more risk associated with the market. The final thing we need to do in part 1 is calculate sample statistics for the market and the risk-free rate. We're going to do this by taking the logarithmic average of the returns from the market and dividing by 100 for percentage terms, and then multiplying by the number of trading days per year to annualize the figure. And then for the standard deviation, the calculation is exactly the same. We're just going to copy that down. And instead of the mean, we're going to do the standard deviation and multiply it by the square root of n. This is the same process for the risk-free rate as well. Take a look at the sample statistics in the console. They look to be close to historical averages, with a 10% return on the market and a 16% standard deviation. And then for the risk-free rate, you have a 4.5 annualized percent return, as you had periods of high risk-free rate and then recently periods of low. And then interestingly, the risk-free rate actually has a standard deviation because it's taking into account unexpected changes in inflation. Finally, we're going to look at the power of compounding and how asset management fees can greatly distort the value of compounding. Our assumptions are going to include a 5% rate of return annually, and our investment period is going to be 40 years. So we're going to create a sequence from 1 to 41. And every year we're going to invest $10,000 annually. So we're going to assign a variable INV to $10,000. And finally, we want to calculate the value of the annuity based on where we are in the investment period. So that's just simply the annuity formula, which is 1 plus the rate of return multiplied by where we are in the sequence or investment period that is then multiplied by the perpetuity, or the investment divided by the rate of return. This in turn is multiplied by 1 minus 1 divided by 1 plus the rate of return to the t power, or where we are in the investment period. This may look confusing, but this is just the annuity formula on Google. We now need to adjust the annuity sequence for the fees. We're going to do this by assigning a variable for the fee as C, and then we're going to combine the fees: 0, 20 basis points, 100 basis points, and 200 basis points. And then we're going to adjust the return net of fees. So we're going to do 1 plus the return multiplied by 1 minus the fee, and then minus 1 to get it into percentage terms. And then we're going to create a matrix of zeros that's 4 columns wide and 41 rows down. And we're then going to fill this in with the annuity sequence with the fees adjusted. So we'll do that by creating a matrix. And then for the first column of the matrix, we already have the annuity sequence without fees. So we're going to use the matrix, subset it to the first column, and we're going to assign that annuity. We're going to create a for loop to calculate the annuity sequences net of fee by a set of iterations. So we're going to iterate the variable I from 1 to 4, and within the body of our loop, we're going to assign the zero matrix we just made, subsetting from the ith column. And then the value we're going to assign is the annuity formula we had above. And the adjustment we need to make here is the rate of return needs to be changed to net of fees, so we can add in the variable RR. And we're iterating over the ith row of that vector. So it's the 5% return, it's the 4.79% return, it's the 3.95% return, and the 2.9% return. The thing we need to do in this video is plot the annuity matrix we calculated. But first, we'll need to set some graphical parameters using the par function, and then within that, the MGP argument. The par just stands for graphical parameters, and within that there's a vast number of arguments, but the MGP argument pretty much just adjusts the axis labels and lines. And then we're going to use the plot function, obviously, and we're going to convert the matrix to a time series. And then within that, we're going to divide the matrix by 1,000 just to make the plot more digestible. And then for the start of our time series, we're going to set the date at 2019. And we're going to be investing 40 years forward. And we're going to want to plot each time series on the same plot. So we're going to use plot.type and then equals quotation single. For the x-axis, we'll just label it as year. And for the y-axis, we'll just label it as wealth in thousands. And we're going to want to add a title, something like power of compounding fees. And once this plot populates, you'll see a huge difference between the return at 5% and the return at 5% with a 2% annual fee. And you can see the difference. With no fee, the return's about 1.27 million. And with a 2% annual fee, the return's around 700,000. So over the life of this 40-year investment period, you're looking at about a $500,000 difference you can see in this console.